Ray the CPA here. I wanted to talk to you today about accounting and why your small business or your not-for-profit, why your organization needs it, or why we do this thing we do. So first, let's talk about the difference between a bookkeeper and an accountant. All right, so a bookkeeper is recording transactions. That's it. That's all a bookkeeper really does. If you get a really good one, there are lots of really good bookkeepers out there. They may assist you in setting up controls just by the way you have to authorize them to do things. They might pay some bills for you as an accounting service. But basically, they're a bookkeeper. What they don't provide is the analysis, the codification, meaning the classifying of your expenses, and they don't provide you any financial strategy. All right, so that's the first difference. The second thing is what is accounting and why do we do this thing? Okay, so the whole purpose for accounting is it's almost like a translation, and I'm going to use all layman terms, no jargon. It's essentially giving one universal language to business. All right, so. But more than that, it provides a framework for you to be able to compare your performance against your future past performance, and allows every organization to compare, well, how are we doing? So if we're not for profit, your financial statements, if done correctly, and that's what we want to do, right? We want to be within generally accepted accounting principles. That's jargon, sorry, but you want to be comparable. Why? So that I can compare your not-for-profit for other like not-for-profits. I can also compare your performance this year with your performance last year. Same thing with small businesses. I need to be able, my roofing company needs to be comparable to itself, its past performance. It also needs to be comparable to all other roofing companies, okay? And that's what accounting does. Accounting says Ray goes to the store and Ray buys desk furniture for his office. Now, if we all did that willy-nilly, so Ray's company buys that office chair, and Ralphie's company buys that office chair, Ralphie's my brother, buys that office chair. If we had no system, if we had no unifying language of business to record that transaction in a certain way, well then Ralphie could record it one way and Ray could record it another way. But now we know we can compare those fixed assets, that's jargon, but we can compare those assets in two very different. Ralphie's organization is different from my organization. Now we can compare those expenses. Or if I make X amount of dollars selling widgets and Ralphie makes Y amount of dollars selling widgets, we can compare. What did those widgets cost? How much did they make for those widgets? How much profit? How much they made those widgets and how much it cost to make those widgets? How much was that profit together? We can compare that. What was their accounting year, their fiscal year? All of those things need to be comparable. So think of accountants as translators. Basically, we translate what your organization is doing into a common, comparable, easily understandable language. And why? Who cares? Well, we care because it enables you as a decision maker to make better decisions about your business. It allows funders, people that are going to contribute or loan money to your business, a unifying or comparable set of documents to decide how they want to make those decisions. So basically, it helps decision makers, internal decision makers, meaning you and your board, or you and your partners, or just you if you're a sole proprietor. It allows you to make decisions based on clear, easy to understand language. Okay, it helps you to do all of those things. All right. If you want to invest in a different project, if you want to be able to obtain funding, if you want to be able to decide if you want to close or open a new location or even your business. Okay, and the last piece is, one of the last pieces is, if you are, depending on what your organization does, but if you are not on a cash basis, or if you have a larger organization and there's lots of cash going in and out, financial records and accounting help you to truly understand the real cash flow in your business, okay? A lot of businesses go out of business because they have recognized revenue too soon, meaning, hey, so-and-so promised to give me some money. That's revenue, yeah. Yes, and there's a little bit more to it than that. But without the standards and consistency of accounting, it's very difficult to really understand where your cash is going because you don't understand how much things cost. You don't understand what's really coming in. And if you don't know that, so imagine taking a road trip and trying to estimate how many hours it's going to take for you to get to Virginia Beach. My mom lives there. So, and my sister. So to get to Virginia Beach, how long is it going to take me? Well, that depends, right? That depends on where we're starting. Well, without an accountant, without accounting, you can't tell where you started. You just get in the car and you drive. But you have no clue how far you're going, how far until you get there, and how long you've come. Got it? Good. All right, Ray the CPA, I'm out. This video was on why you need accounting. All right, take care. Keep those questions coming. Be sure to subscribe, like, follow wherever you're seeing this video, and interact. All right. I'm doing these videos for you, putting out good content that's good for you. So I need to know. Keep them coming. Keep those questions coming. All right. Thank you. Have a great day.